Hello guys, welcome to my channel Trader Sherlock. So today I'm going to be uploading the second part of the Harmonics series and it's about important points about Harmonics and what are the main points you should keep in mind for becoming a Harmonic plus price action trader. So without wasting any time, let's begin. The important point of today's topic is about invalid harmonic setups. So let's explain the definition first. Although anything can happen in financial markets, harmonic setups that experience price action that acts completely opposite to what is anticipated usually will provide signals to indicate the flawed nature. You know that price action cannot be foreseen. You cannot predict what will happen next. It trends upward, downward, sideways. You don't know. During this, when the harmonic is plotted in the price action and the price goes against it, it is called as invalid harmonic setups. And there are multiple signs called warning signs which makes the harmonic setup invalid. So let's learn about this harmonic setups invalid warning signs in detail. What are warning signs? Blowouts such as price action occur when the potential reversal zone are completely violated. So these warning signs occur when PRZ, potential reversal zone, are breached. So anyone who's new to this channel and seeing this second video for the first time, please reverse to the first part because I have explained the major terms such as PRZ, ratio, and harmonic patterns, so you'll understand it better. So when these blowouts occur, there are warning signs like price gap, tail closes, and extreme price ranges which are formed, creating the harmonic to be invalid. I'll just give a small example with this diagram here. This C point is the potential reversal zone, and in this diagram, it is telling that the from this C point there might be a reversal. But if some of the warning signs like price gap, tail closes, or large price ranges occur above the potential reversal zone, then this setups become invalid. So let's learn these warning signs in detail by going to the next slide. First one is price gap. What is price gap? It is very common for price gaps to occur in a potential reversal zone. A price gap occurs when the price action opens beyond the previous close, leaving an open area where no trading has occurred. A price gap in a potential reversal zone indicates that setup is to be treated with extreme caution. So I'll be explaining this price gaps with a live example in Bank Nifty. So first let's understand the example. You might have heard the term gap up and gap down. So whenever a gap up occurs above the potential reversal zone or below the potential reversal zone, it tells that the trend has significantly changed and there is a huge change in the sentiment. Let's look at it in a example of a live chart. So here is the example of Bank Nifty, and there is a specified potential reversal zone and a pattern formed with 0.5 ratio colliding at point D. This point D is the reversal zone, telling that from here there is a change in the trend and there might be a reversal and the price might move up. But what happened? There was a gap down. Let's go back to the definition. Price gap in a potential reversal zone indicates that the setup is to be treated with extreme caution. It is important to respect an extreme sign like this because a price gap indicates significant change in sentiment. So when this gap down occurred here, that it refers that the sentiment has changed. What sentiment? From T point, it was telling that the price might reverse and it might move up. The bullish sentiment has changed to bearish. And as you can see, when this gap down occurred below the potential reversal zone, completely become a bearish trend, and from here the price started to fall completely. This is about gap ups. So this is the opposite side of when there is a upward reversal move and the downward reversal move. This was in the bullish term, and when there is a bearish potential reversal zone, it is the opposite of this. The trend might be in upside. I hope you understand the gap up. Let's move on to the next one, that is tail close. What is tail close? Tail closes are price bars that close at either high or low. Tail close suggests that extreme price action is to be respected. When a tail close occurs after hitting a potential reversal zone, it should be in extreme caution. When price action closes at high or low of the day, it indicates sentiment is overwhelmingly strong. So in simple definition, I'll tell you, tail closes are something in which the candlestick closes above the potential reversal zone or below the potential reversal zone. I'll give you an proper example in the Bank Nifty chart again. So as you can see, a specified harmonic ratio was formed. And please observe this point here clearly where I'm pointing the cursor. Here at the 3 ratio, it was telling that the potential reversal zone at this point. That means around 45,610 the price. At price 45,610, the PRZ was located. That means the price has to hit the PRZ and the stock had to reverse. But what happened? According to the definition, tail closes are price bars that close at either the high or low. Here, the candlestick closed above the potential reversal zone. That means it indicates the sentiment is overwhelmingly strong. Along with this, you should please keep an important point in mind that This tail close refers to a pattern where the harmonic setup is invalid, and also this pattern can be valid. This might be confusing, but I'll clear it in the example. When this type of tail close was formed, you might have thought that okay, there is a change in sentiment. No, but what happened? Look at the example. It is common sense to wait for an obvious reversal signal in this situation because of the strength of the price action. Therefore, a tail close is a clear signal to step aside and let the market give you the signals of when to enter a trade. As I said, this tail close setup is 50-50. 50% it can be invalid and another 50% it can be valid. So what happened in this example? After this tail close occurred, when the candle closed above the potential reversal zone, according to definition, we should have waited for next reversal candle to occur. What was the next candle? It was a proper reversal candle with a bearish candlestick occurred, and as you can see, this harmonic setup was valid and the price started to fall continuously. But what if the price had closed above this potential zone and the stock had started to move? This tells that this harmonic setup is invalid and the bullish trend is in continuation. I hope you understand tail close. Let's move on to the next, that is the extreme price ranges, that last one. Extreme price ranges also reflect a very strong trend. One way to determine if a price range is extreme is to compare it to average range. Oh, so this is simple. If a stock trades greater than 2 times of its average range, it can be considered extreme. If the extreme price range reflects an exhaustive price move, the next price bar should not continue in the same direction. I'll explain in the definition first, then let's move on to the live example. Extreme price ranges are those candles which are twice the size of the normal candlestick. And whenever these extreme price ranges close above the potential reversal zone or occur at the potential reversal zone, that means that there is a significant change in the sentiment and the setup might be invalid. It's same as the tail close, 50-50. 50% it can be valid and 50% it can be invalid. So let's look at the chart. These marked candlesticks, which I have marked here, 2 candlesticks, these candlesticks are called as extreme price range candles, which are twice greater than the normal candlestick. This is a normal candlestick which I'm pointing at the cursor. You see the size of these normal candlesticks and compare it with the extreme price range candles. There are twice or thrice larger than these candles. So I don't have the potential reversal zone or the harmonic example. I'll just tell you in this chart. So example, there is a potential reversal zone formed at this candle, telling that from here a bullish reversal might occur, but this extreme price range candle closed below the potential reversal zone. And what it tells that whenever these type of exhaustive price move occur, the next price bar should not continue in the same direction. And when this big candle occurred, the next candle was also similar to this extreme price range. That means that this setup is invalid and the stock will continue in the same direction. I hope you understood what is extreme price ranges and price gaps and also tail close. It's simple with the example. This point is very important to keep in mind, because whenever these 3 price ranges occur, you should be very careful, because harmonic does not work every time. These are warning signs which occur sometimes to keep you away from the trade. If you don't know these warning signs, then you can't be a harmonic trader, because each time you'll think that harmonic works, but no, when these type of warning signs occur, harmonics fail. So it's important to note down these warning signs and keep it in mind, because harmonic trading is all about memorizing the patterns, ratios, and the direction of the trend. Thank you. And the next upcoming videos will be detailedly about patterns, how to use harmonics, and some of my trades which I have taken using harmonics. So please stay tuned for this harmonic series. I hope you understand this extreme price ranges and points to keep in mind. Thank you.